Hey everyone, happy Wednesday, September 13th. It's about 11:15 on the West Coast and time for another market update. Like I said last week, I'm going to be traveling tomorrow, so I decided to do the video one day early, and it makes sense because we got, important market news today. We got the fresh off the presses, we got the August CPI inflation data. So taking a closer look at this stuff, and obviously this is very important because the Fed's paying very close attention to all the inflation thing that comes out, before their meetings. And headline went up 0.6%, which was expected. Year over year rose from 3.2% to 3.7. Expected was 3.6, so a little bit higher than expected. But remember, on these year over year numbers, they're replacing this August headline number is replacing August of 2022's number. So the reason that would rise from 3.2 to 3.7 is last August this was only 0.1. So again, keep that in mind, in case you hear something on the, mainstream news, how things jumped. A lot of times it just has to do with the numbers we're replacing. And then the core was up 0.3. So core takes out food and energy. There's a debate about which one of these is more important, the core headline. But the year over year for the core actually dropped 4.7 to 4.3 because last year's core number was a little bit hot. So it's good to see the core coming down because according to the Fed, that's the most important thing. But we'll kind of see what they say because in the past they said headline, and then lately they've been saying core is more important. So now that we saw the core drop but the headline go up, let's just hope they stick to that and stay the core is most important. Where we got help, used cars were down. Energy is where we got hurt a lot. And we kind of talked about this last report that we weren't sure if the increase in energy prices, increase in oil and gas would show up in the July report or the August. And it showed up in the August report. Food wasn't that bad. Food was pretty tame, but the energy and gas are the ones where we really got hurt in this headline number. Because remember, food and energy come out of this core number. Where we got some help in the core number was the shelter. We've talked about this. Shelter numbers, have been really, really high. We'll look at a graph here in a second, but that dropped from 7.7 to 7.3, and that makes up 43% of the core number. Rent came down a little bit. Owner's equivalent rent, which is not like their mortgage or anything. What that actually is when they're trying to guesstimate what you would, an owner would get for rent if they were going to rent their house. And lodging away, which is like Airbnbs, hotels, and all that. So shelter helped us a lot. That kind of offset the other stuff, and that's why we got those gains in core or drops in the core rate. So we looked at this graph before. It has to do with shelter costs. As you can see, this crest of the hill is finally starting to happen. It happened back here in real time, but now on these reports, we're finally seeing that coming down. And going ahead, the year over year or the month over month numbers, through March, we have very friendly comparison numbers. So when we get these new shelter numbers for each month until March, we're replacing, high numbers from last year. So that will make this number coming down more and more and more, which will help the core come down and so forth. And remember, the core PCE, what the Fed wants, they want to get it down to 2% for the core PCE. Right now, it's at 4.2. If we took this lag into effect, we're at 3.25, which again, we're getting closer. So hopefully the Fed sees that and takes that into account with everything they're doing. Next thing we got was... Well, actually, tomorrow we're getting job claims. So I'm not going to be here for tomorrow, but it's expected to be at 226,000. That's been about the level it's been lately. Keep in mind, that's very important. The Fed's paying close attention to that. Job market's been really tight. We haven't seen these being going up that much, but a big miss there, so a way lower number, or a big jump there would move the markets potentially. And then apps last week. Purchase apps were up 1% last week, down still 27% year over year. Miscellaneous stuff. So we got CoreLogic, one of the appreciation reports. We got CoreLogic for July. So as we can see, all these different ones, they've all been going up. So CoreLogic is the first number we got for July, and that was up 0.4%. So they're on a percent, according to them, 9% appreciation across the country. This is the 2023 pace. As you can see, these are all at all-time highs. July for Case-Shiller, we're probably going to get an all-time high. So then we'll across the board, all these different metrics will show all-time highs. Again, this is nationwide. This isn't regional. This isn't specific to Bend or the Bay Area or whatever. So keep that in mind. But it's good to see for homeowners. It's good to see for the housing market overall across the country to show strength and not have these big negative numbers like a lot of doomsayers were saying at the beginning of the year. And then also we got August PPI comes out. So that's the producer price inflation. Again, that's going to jump. The numbers are going to jump, but last year was like a negative 0.2%. So last year at this time, it was a negative number for August. So if we get any sort of positive number, which is not expected to be a big jump, the market that you might see on CNBC, that kind of thing, like, inflation is jumping. But again, just remember how they do these year over year numbers. You're always replacing a number from last year. Where does that leave us? We're down to about 7.25%, 7.25%. Last week we peaked about 7.33%. So not much movement this week. We're all kind of holding our breath. Next week we get the Fed. The important date. Next Thursday or next Wednesday is the Fed's meeting. It'll be probably the 19th and the 20th. The 20th is when they'll be making their announcement of what they plan on doing. Raise, hike, that kind of thing. It's always like the Groundhog Day deal. We'll also get their press conference, and that's always important to take a look at, just because we might get some clues on what they might do going forward. But right now the markets have it at 97% that they will pause, which we want. 3% chance that they'll hike. So very, very sure deal that they're going to pause. Everybody kind of knows that for September. But then November 1st is the next meeting. And right now that shows it at 58% pause, 42% some sort of hike. And then December is about the same thing, 54%. So right now the market's confident they're going to pause here in this meeting next week. But going forward, the last two meetings of the year right now, it's basically coin flips. And so what we need is inflation data to keep coming in as expected or lower. We need job numbers to be, at least not showing tremendous strength, show weakness there. And then hopefully the Fed pauses, and then that eventually leads to a cut. That's what we ultimately want, is rates to come down. So, not a lot of stuff came out this week. Rates stayed pretty steady, but we got to keep our eye on that meeting next week, because you never know what the Fed's going to do. Hopefully they don't drive us over the cliff. Hopefully they're not the fool in the shower. But if anybody needs anything at all, please don't hesitate to reach out, and I'd be more than happy to help. Have a great week, everybody.